It's Friday, March 25th, 2022, episode 173. I'm Patrick Serezna. We have some last minute changes in this week's format as I'm going solo. Kevin had a fight with a squash ball and ended up with a mild concussion, so we gave him the week off to recover. So we invited our good friend Chase Taylor from Pinecone Macro to pinch hit for an extended talking chart session, and we'll be back to our normal format next week. All right, Lena, hop on. What beer am I drinking this week?
This week you are drinking Calamita Lager from Cerveceria de Colima. It's a Mexican beer once again.
Yeah. It's my last week in Mexico, so we'll be switching the brands of beer. But it's, you know what? I just took a sip of it right here. Does
it taste like summer?
No, you know what? I don't know. I guess I'm not a big fan of lagers. It just it feels a little too watery. Like it's a very summery. I guess it is a summery kind of light drink.
When you drink beers every week, everything's going to taste like water.
There you go. Anyway, so Lena, yes. You're going to pinch hit and give us some side effects.
Oh, before I get into side effects, though, I would like to remind everybody, please show us some love and go visit our merch store at markethuddlemerch.com. And remember, if you make a purchase until April 11th, all the proceeds will go to helping Ukraine-based employees for Koifun charts. So please give us some love at markethuddlemerch.com. And nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. Side effects of too much huddle may include receding trend line, sickle didn't sell anemia, no, not enema, anemia, quantitative wheezing, and apparently squash ball to the face.
There you go. So. That's definitely a side effect. Anyway, let's get Chase on the program. So we have the great pleasure of having Chase Taylor from Pinecone Macro join me for some talking charts. And Chase, I wanted to thank you for pinch hitting on short notice, for stepping in here and helping me out. I'm looking forward to talking some charts. You know, we were discussing with Kevin as to who's a good person to call and step in. And I was like, our good pal Chase is one of the best to talk charts with. So I'm so glad you decided to join us.
Yeah, you know, sometimes the Lord of the Crayon needs another crayon guy to commiserate with. So here I am. Absolutely,
and just to prove that the crayons are real, we'll see how many things we agree and disagree on, right? Anyway, but let's jump into it. Now, I know you came up with a couple of things we want to talk about, but let's just hit straight into the markets and talk this S&P 500. And one of the things, obviously, we've been in a several month correction that was, the 15 to 20% variety. And finally, a relief rally is underway. What's your take on the current situation? Is this just exactly at an oversold bounce, or do you think the market correction is over and there's more upside?
Yeah, from a fundamental perspective, it seems like just kind of like a technical bounce. But if you just showed me the chart alone, I would think it was really bullish. I mean, it looks like a giant bull flag that we broke above. Even today's price action is really bullish because we're breaking above the last, 3 days of action. So,
yeah, and like you draw a trend line like this down here, you've got that clear breakout on the upside as we're approaching some of those previous highs, right?
Yeah, and even horizontally, you kind of go back to those lows from like December, things like that. We're kind of breaking above that area, so it looks good. But when I see, what yields are doing, especially on the front end, it is kind of hard to square, being able to keep going with the rate of change of yields just exploding higher.
Well, that is something. We'll get to that here in a second because I want to talk of bond markets here in just a moment because it is certainly a worthy story. But it is surprising to me that the equity markets have not responded to the bond market puke that's happening. And you would think that how high do yields have to go before the stock market starts to care?
Yeah, exactly. And a lot of times it's that rate of change on yields that kind of really like where the market starts to take notice. And we have that right now. The market doesn't care. But like you kind of say, like maybe it was just we were so oversold, we were going to get the bounce almost no matter what, the rest of the environment looked like.
Right. There's no disputing that the Nasdaq and the technology stocks were the kind of the culprits where almost all of the heaviest selling has been occurring. But I wanted to touch on the Russell here, and I thought it was pretty interesting that though the Russell was one of the weaker indices right off the bat out of the gate in November and December, really during most of this year, year to date, it really has been very flat and consolidating, but it at the same time hasn't exploded higher the way the S&P has on that reaction. What's your take on the small caps?
Yeah, it's a great point. And we were talking about kind of taking out the lows from December on the S&P and all, we had like obviously I think everyone knew, the Russell had that enormous like kind of rectangle for really like a year or two. And all the lows from like the summer and the fall and even the winter, like we haven't taken those out yet. And that's pretty significant, I think. And it kind of makes sense, they don't get the same giant passive flows and maybe even capital inflows from overseas as folks kind of freak out about the Russian invasion and everything. So it makes sense, and it still has a lot more work to do than the S&P does.
Right. And just wanted to, before we move on, just touch on this VIX, right? And I mean, we went almost an entire month of volatility staying, or the VIX staying above the 30 handle as vol premium stayed very rich throughout that entire start of the Russia-Ukraine kind of geopolitical mess that's going on. But really, its volatility has almost collapsed. I mean, we're trading very close to the 20 handle here. I mean, obviously that gave like a Vanna slingshot to the S&P on the upside. But the question I'm sort of pondering is can we see under these kind of market conditions a VIX that goes under 20?
I mean, we could see anything, but to me it's too cheap here for sure. Like especially I kind of feel like there's a Fed call at this point, and Jay Powell's doing his best to get markets down, and it just won't work. So like, no matter what he says, market doesn't care, and eventually he's probably going to turn the hawkishness up to the point where we have to, the markets kind of have to care. And to me, VIX is cheap here, even though 21 historically is not super cheap. But to me, with this whole environment and everything that can go wrong in markets, it's cheap.
Oh, for sure. So let's jump to these bond markets, and let's chat about this. Let's start with just the yields, and a lot of the action remains at the front of the curve, right? The 2s and 5s, like just an absolutely explosive move. Even today, now up to 230 basis points on the 2-year yield. But you were earlier saying the rate of change, but it seems like the move on the upside of yields is actually outright accelerating.
Yeah, big time. And the belly is crazy. I mean, the 5 years up 17 basis points today. It's just that is a monumental move. And we had that huge rally and then a base and then a giant rally. Like the technical strength is immense. So
right, and it's what's interesting is that while you have all the yields are moving, like the 10-year up to 250 basis points pretty much. You got the 30-year yield just crawling right back to its week high. It just keeps moving. But the other part that I thought was really interesting was that we almost have inversion on some of these different curves. Like look at what the 5s, 30s have done. Like it literally is about to invert. We're almost
it can happen. Like even today possibly. That's how intense that is.
Like we are virtually going to see an inversion in a week. Like you're saying, it could even happen today. But this is an outright collapse in this. It's stunning to watch and see, right? Like those that are looking at this as a indicator of a potential recession. I mean, you all of these, like look at the 2s and 5s, sorry, 210 it's just down to 19 basis points, just unbelievable flattening in there. And the question really in the back of my mind is how long. First of all, how low does it go in this, and how long does it last? Like usually in the past, this has marked some sort of a recession, 6 months to a year forward. Do you have an outlook in term or an opinion as to like economically whether this is going to actually mean something? Do you think there's a recession risk moving forward?
Yeah, I actually do. And I spend most of my time making fun of recession people and just perma bears in general. But I do think we're at the point where we're gonna probably have a recession. But I think it might kick off a little later than expected. The inventory cycle can kind of keep growth, higher for longer than I think a lot of people expect. But I think the recession risk for next year specifically, maybe especially like kind of later into the year, is significant, especially with food and energy inflation are just not going to let headline inflation kind of go back down, and which probably is going to keep the Fed hiking and starting to get up into those 50 bip hikes. I wouldn't even be surprised if we see at least a whisper of a 75 basis point hike before the year's over. So that's the kind of
Wow.
thing I think can get equities to
Well,
realize what they're dealing with.
this is the part that I find shocking. It's like it's one of these scenarios that I've found throughout my trading careers. It's like that's that old saying of nobody cares till everybody cares, and then everyone cares all at once. And the thing is, it's like the bond market is eating it. Any portfolio manager that's running a 60-40 portfolio is just getting chewed up right now, and because of the bond component of their portfolio dragging on there. And yeah, you'll have to kind of in the back of mind think is like, can it just be that the equity market brushes this off, or is it just going to be one of these things that after such an extensive run, like I recall back during the flash crash of back in 2010, we had a scenario where bond yields were just ripping and ripping higher and ripping higher, and the stock market didn't care. And then comes this liquidity event that just hammers the stock market in just one day. And I wonder whether or not we just saw like a technical bounce that was driven by option flows and other things in a very oversold condition. But then once everyone sees that the upside momentum has stalled out, I wonder whether suddenly there's an increased risk that the stock market starts to actually just price something in and surprise everyone.
Yeah, it's interesting. And you mentioned the flash crash, but if you go back to 94, which is kind of what Jay Powell's even talking about now, I think they raised by like 300 bips that year, and the stock market was down 2%, which I think if you were told how tight policy was going to be, and that got up to like 6% on Fed funds, I think. And the market didn't really care. Like it had a couple sell-offs within that, but it wasn't
Yeah.
that violent. And I think there were like 250 basis point hikes and even a 75 basis point hike. And that was the one that the market finally didn't really appreciate that. And it wasn't too long before they were back to a cutting cycle. But it does show that you can have pretty extreme, tight policy bringing accommodation out without having significant weakness in the market. And, it could just be a situation where the economy is so strong right now that it requires really significant accommodation to be pulled out for it to matter for the market, and that could just be what we're dealing with.
Right. I mean, the question really about, obviously that this is a lose-lose situation for the Fed, because in order to try to quell inflation, they basically have to hammer growth. And right now the market is not really pricing in much lower growth, and everyone is believing that they're going to be able to tame in inflation, and something's got to give. And the Fed is stuck in a hard place because no matter what, they're about to cause some shit. And the fact that the stock market is where it is It does make the case that the stock market is going to have an upper ceiling, like whether or not it ends in a liquidity event and some massive market drop is something that is never a certainty, and nor is it even something that you need to stick your neck out right now and make a bold call on that. But certainly you would think that the stock market is going to find it very hard to make any upside momentum breakouts. Maybe we won't even. Do you think that there's a chance we print 5,000? Like, I know you always say anything can happen, but is it possible that the market makes a higher high in this sequence, or is it just going to be a grind?
Yeah, I don't think it can, and the biggest reason is I think Jay Powell's so focused on financial conditions that if we start to get even close to that, I mean that's going to be loosening financial conditions, and he's going to drop the hammer. Especially if growth if there's like a lag between policy and growth kind of falling apart, that just allows him to be that much more aggressive with policy. And I just don't think he's gonna let the market get to like that new high, especially really kind of break out. Because to me, like we really have gone from a Fed put to a Fed call, at least short term.
Absolutely, because in the end, if they created a momentum in asset prices, it's going to have that wealth effect, and it causes more spending. It's going to be counterproductive to quelling inflation, and so it's certainly the case that it's going to be a grind here. But what has been working have been commodities, right? And so let's jump into some of these commodities, and then we can move to some currencies after that. I know you wanted to talk a little bit of copper here in a moment, but let's just start with the big boy, with crude oil. And what was interesting is we obviously had an incredible parabolic rise at the start of March as this geopolitical escalation started, but that was quite the retracing move back on the downside, close to a $30 drop on the downside crude oil in just days. But it's been more or less grinding higher. What's your opinion here? I mean, do you think that this is just setting up to still launch to 130, 150, or is there some sort of a short to intermediate high put in here?
Yeah, I definitely do not think the high is in. The fundamentals are incredibly strong, and really, I think this was kind of a structural issue, especially around if you look at like open interest for either WTI or Brent, but especially Brent, it's collapsing because they keep raising margin requirements. So everyone keeps getting shaken out of futures positioning. I think that's a big part of this sell off, and I think the fundamentals suggest we should be much higher. So that's where I expect us to go. But we even had another margin increase today.
Yeah, do you have some targets in mind? I'm going to switch it to like a weekly chart. Like, I know that there's a number of people in the Twitter space, including our good friend Cuppy, who are calling 200 on the upside. But what's your kind of view as to where this could all kind of come together to the upside?
Yeah, I was making fun of folks like Cuppy behind their back for these $200, $300 calls for the last few months, but then as soon as the invasion, happened, like that's all of a sudden nothing to make jokes about. I think it's very possible to go to 200. Inflation adjusted, you got to get above 200 to even get to a new high. So I think that's very possible, especially if Russian barrels are going to come offline at say 2 to 3 million barrels. Then it's very difficult to avoid 200.
Right. What's interesting is that as crude oil came back to that 50-day moving average there, that's the EMA here, on that and found support, we obviously got a bounce. And when you drop $30 in a week, getting a reaction the other way is the typical ebb and flow of the way prices move. But this is actually a very interesting pivot for me technically, right around this 110 to 115 level on crude, because a bounce would, let's just use a 50% retrace of the move as a baseline. When you have this kind of a bounce, it's just typical reaction. But if the bulls really remain completely in control, we should see a breakout of these levels. Once we're going back toward its previous highs, there's nothing stopping it. I mean, we could end up being 140, 150 even in weeks. And to me, it's all about whether or not the bulls can beat this short-term hurdle. And so that's definitely the kind of area that I'm watching. But absolutely, like the trend is certainly still up, and the bulls continue to buy all dips, and you have to respect that bull trend, and I wouldn't fight it here. Now, one thing I always kind of highlight to my members is like right now you have really two choices: either to be long oil or to be neutral oil. It's almost suicide to consider shorting it here, right?
Yeah, I mean, with the geopolitical risks, especially, and going into the summer where inventory draws are going to go from bad to worse, there's so much right tail there that it would be kind of crazy to be involved, on the short side, in my opinion.
So I want to talk some nat gas, and I know you track some of these different nat gas contracts. Now, on the continuous chart, it looks like nat gas has not beat its previous highs, but that's because the nature of the term structure of nat gas and which contracts were there. But when we look at some of those near-term contracts, like for instance, let's go to the May contract. I mean, nat gas is ripping to the upside here. First of all, are you long nat gas, and what's your opinion here on the nat gas story?
Yeah, I've been long nat gas for a couple of years now, and I'm long December of this year. Well, actually December of next year. I try to take some of the vol out, but yeah, I'm very long, and I think you're getting a mixture of some cold weather for April, and obviously the LNG party is getting a lot of headlines right now, even though we can't really, the U.S. can't increase exports significantly this year above what's already going to happen, but it's getting a lot of headlines. But really, I think the real driver here is some of the weather models for April are, showing some reasonable cold coming. So that's really a significant driver.
Well, if that's your base, do you think that on the short term it's getting a little ahead of itself, and that we're going to mean revert this kind of breakout on the upside, or do you think that this has got more room to go?
Honestly, at this point, it just really comes down to those weather models for kind of April, May. And after that, we're 100% out of the woods for the cold, and it becomes really more about heat. But at the moment, like, if you keep getting these draws kind of when you're expected to kind of enter that shoulder season, then I think we can keep moving higher, because inventories are they're kind of like right in the middle, where a little bit of movement either way creates a significant price impact. So if all of a sudden those weather models heat up, and they can at any moment, then yeah, you can have a pretty nasty correction quickly.
Yeah, some of those nat gas stocks, like the two that I like to track, Range Resources, just another big rip today on the upside, just plugging along. And then Cuppy and Josh Young have been on the show talking Sandridge,
Yep.
And that's just trying to break out to a fresh new 52-week high. Like it just feels like these stocks are just gaining a little bit of some upside momentum. It's kind of hard to chase, like when we were talking Sandridge at $5-6, that it's suddenly a great opportunity at 17. But if you're in it and you've been riding these nat gas stories, like I wouldn't be shocked if we saw $19-20 on the upside of Sandridge in a week or two. Like these stocks just keep working, right?
Yeah, absolutely. And this is one I've owned for a long time, and it's been great. I actually trimmed a tiny bit of it today, just to grab a little bit of cash. Only a tiny bit, but.
Well, you know what? Well, kudos to you holding, because I did a lot of my selling back last year around $13-14, and
I'm sure
I've been reluctant to go heavy back in, and now I'm feeling a lot of FOMO. And so
that's how it works. I mean, the risk reward on all these like nat gas names is just not the same as it was a year or two ago. People are actually understanding the fundamentals now.
Yeah, no, for sure. Anyway, so let's talk some copper. I know that you wanted to talk COPEX. So let's start though with the actual underlying commodity, right? And we've been, well, copper was super high. I'm going to go on a weekly chart and just let's zoom right out. But there was one extraordinary copper bull run in 2020, 2021. And we went through what was pretty much, we can round it to a 1 year sideways consolidation. Just it just paused and did nothing for an entire year. And here we had an attempt to break out to a fresh new high. And I know we're going to look at the COPEX chart that has a similar echo of that. But do you think that this is a legit breakout here? And are we going legitimately north of 5 here?
Yeah, I think so. Obviously, we have kind of retraced back to like the scene of the breakout. So at the
Yeah.
moment, it looks dicey. But one of the reasons I am confident is because COPEX itself looks way better technically, and it's kind of clear to me that China keeps running into growth issues that they're going to have to stimulate their way out of. And so I think part of that, is I'm sure going to create some incremental copper demand. So
Yeah.
I think you kind of have the macro case and the technical case, and the fact that the equities the equities are ripping while copper itself, at least front month, tries to kind of make up its mind.
Right. So here we have that COPEX chart, and just looking at the copper stocks, the miners themselves. Well, a great basing formation over the 2016 to 2020 period, and it's decisively now in a bull trend, and it'll be really interesting because on a monthly chart, right? So this is zooming out, everyone. So everyone needs to recognize when they're looking at this chart that this is not a forecast for the next 2 weeks. This is looking at the 2023 and 2024 kind of where's it going for the next couple of years. But with this, if it breaks to a fresh high, it's fair to say that it can make a run to its 2011 high there in the 60 to $65 range. Is that the level you're targeting for this?
Yeah, absolutely. And in fact, on the monthly, you can kind of draw that horizontal line using those 2011
I'll draw this.
areas, and that's like kind of the natural target, and an area we probably will have to struggle with because it was, there's a lot of supply at that line, especially if you kind of use the candle body tops. That got tested like 6 different months basically.
Yeah, yeah. Well, there's a whole array of these different lines to be watching for these breakout, but it does really, and this is the interesting part, right? Because I mean, we got a Fed that is trying to fight inflation. And the way that they intend to fight inflation is to hammer growth. And the thing is that the underpinning supply of these commodities, a lot of these producers simply have not put new projects into work. And the thing is that it's going to be really hard to kind of quell this momentum. It'll be really interesting to see whether this year just sees these commodity trends just keep hammering higher, right?
Yeah, absolutely. And obviously, monetary policy can do a little bit on the demand side, but it can do nothing on the supply side. And the supply side is really kind of where the problem is here. And in fact, we need these prices higher to help on the demand side. So yeah, I don't see monetary policy having a significant impact on commodities, at least soon, the way it could with kind of like longer duration assets on, like some of the crappier tech stocks. Like I can see
Yeah.
those continuing to have problems, whereas short term, like oil doesn't care if, rates go up, or, I mean, at the moment, you're getting so much stimulus for energy, and it's globally. It's so many different states in the U.S. are offering different kind of stimulus offerings and free money and subsidies for because of energy prices and food prices. So you're not really going to hit demand, but yet you're not really getting that supply response, at least yet.
Yeah.
So yeah, you can have a weird scenario where like the economy's slowing, even all the other areas of inflation are slowing, but commodities just kind of keep ripping short term.
So let's talk some coal. Which are the coal stocks that you'd like to track?
So I track a few. BTU obviously is one of them. I sold a lot of BTU, most of it, but it's been doing great lately. I
Yeah.
think when I sold some, it is about when it bottomed naturally. But It's been doing well. ARLP, Alliance
Yeah.
Resources, is another one.
You know, it's interesting. Like BTU had that huge pullback,
It's about
and
50%.
yeah, and Alliance Resources just held up like a champ.
Yeah,
Like it's really been one that has been resilient throughout the whole process. Like I remember selling a whack of $2.5 and $5 puts for income, and boy, like while they made me a pile of money, I'm like, man, I should have just bought the stocks instead. It's
yeah.
when it was back down there, it was an amazing run this has been. But do you think there's more room to go on this coal story? I mean, obviously you just said you were doing some profit taking, but was that more of you have better places to put the money to work, or do you think that this is kind of approaching the ninth inning and it's time to plan an exit on on the story?
So I was doing most of that selling a few months ago whenever China basically just did an all-out attack on coal because it hit coal kind of globally. But what I did was redeploy a lot of the BTU money into ARLP because it was performing so much better if you like charted the two against each other,
Yeah.
especially. But now that we're sort of having a significant nat gas shortage, like that means A, people literally need more coal, and B, coal, on a price versus gas price perspective, especially in Europe and Asia, it's just going to be too good to pass up. So there's a bull market that I don't think is going away anytime soon. And there's an Aussie name on the ASX, New Hope. It's NHC. That's one that I have been in the entire time. Kind of smaller position, let me just not touch it, and it's been doing really well. And
Oh wow.
yeah,
Yeah.
Aussie coal got hit hard whenever China, stopped buying it. But now all of a sudden, everyone needs Aussie coal again. And they even have a little bit of like oil and agricultural stuff on their balance sheet. So it's kind of a perfect storm.
Well, you know what, though, when I see a chart like on New Hope here, it just uh, it's reminiscent of so many of these parabolic moves that you
Mm-hmm.
see. It makes me always a little bit nervous, just like crude oil being capable of throwing back $30. When once you have that upside volatility going parabolic, the mean reversion corrections on the other side tend to be just as volatile. And so when you see these kind of stocks going up at this pace, it always makes me a little bit hesitant to want to chase something like this because you know the type of volatility it's capable of. Do you think this is one of these you just kind of at this stage either you're in or could you consider you still think there's big upside on something like this?
So I definitely think there's still big upside, but you're absolutely right. It's in a parabolic rise, and I mean, look at that enormous gap, and that was
Yeah.
at a level that had been it had been knocking on the door of that level just under 3 for a couple weeks, few weeks. So like it's a perfect area to get a gap fill. So trimming some now and then redeploying it on the gap fill there just under 3 is just kind of a perfect kind of trading setup to me. So that's
Yeah.
probably what I'll do. Now what'll probably happen is I'll trim and then never get filled on that gap, but that's okay. It's still the best way to manage the risk, I think.
Well, yeah, there's definitely you have to be a little bit tactical. At some point, you got to learn to take some profits off the table. That's the way you
Absolutely.
keep them, right? And,
That's to
and
me
so,
to me like profit taking and trimming on the upside that I always refer to as dimmer switch trading instead of light switch trading. And to me, taking profits is just as much of risk management as it is, cutting your losers. Like I don't understand the concept of never trimming anything. Like, it doesn't make sense to me. To me, that's risk management too.
well, Chase, I have a whole array of programs at Big Picture Trading, and one thing that I have always said to my students and members is like everyone takes the programs, always asking the question, "Tell me what to buy and when to buy it." But what I have learned
Mm-hmm.
through my 20 plus years of trading is that you could have people buying at all sorts of levels, but the people that are successful versus the people that fail all know when to sell. The sell decision is actually exponentially more important than your entry,
Absolutely.
and learning to profit take at right times is just such a critical thing. Let's talk uranium though, bud. And like uranium. was I'm using the SPRA physical uranium here as it trades on the TSX, but after a huge breakout back in September, it spent a better part of almost 5-6 months just consolidating in this declining. I guess we could call that a triangle or something like that, just a consolidation. But this breakout that happened a month ago seems pretty real. You think this still has legs?
Yeah, I mean, to me, uranium has a lot of legs left. And Kobe hit on a lot of the fundamentals last time he was on, talking about like the underfeeding and overfeeding, which for me, I just picture myself at a buffet when he was talking about that. But I, yeah, I think the fundamentals are I mean, I've thought this, for 6 years now, but yeah, I think the fundamentals are great, and we have to go a lot higher for this to really make sense. And it's actually one area where I just don't really take profits yet, because until we kind of get to a uranium price of about 100, I just don't see the point.
Oh, and the one thing that I have learned is like you got to zoom out. Let's put this like on a weekly chart or something like that. Like we are in a very early stage. We're only like 3-4 weeks into this move, and typically when bull breakouts happen, they often can last 6 months or a year. If this is a legit breakout, it is way too early in a cycle to be exiting these trades, right? And the big key thing here is to see whether they can make the rally stick. Right now, I think that it's very realistic to see this SPRA physical uranium trading at 2021 on just a short-term impulse, but that would really solidify the higher highs and higher lows. Obviously, there'll be pullbacks along the way, but I think that uranium needs to be treated as a buy on dip perpetually. Every time they give you, if some of these uranium stocks, they give you 10-20% pullbacks, it would be foolish not to put some money to work when they gift you a pullback, right?
Yeah, absolutely. And I mean, on the fundamental side, you have pretty much every corner of the earth is all of a sudden either getting interested in more nuclear plants or some new, nuclear plants. So
Yeah.
you think about if you're in Japan, like all everyone can talk about is sending their LNG to Europe, and so they have to be kind of scratching their head, like, well, what about us? Like, we really need it. So I expect them to dramatically, you know, bring forward the timeline of getting all their reactors online. And even South Korea, who kind of turned anti-nuclear, might have to kind of put a pin in that at least. Same with most of Europe. It's just kind of it went from being a luxury to get rid of it to kind of impossible to get rid of it. So the demand side for uranium is going to be significant.
Yeah, for sure. Now, what's interesting for me, so here it's a weekly chart of the uranium ETF, the URA, and what I thought was really interesting was that while uranium itself is not far off from a 52-week high or a fresh high on the move, but a lot of these uranium stocks, using this ETF as an example, have not made it back to that September-October high. And they're almost lagging. Do you think that there's something going on with that, or do you think it's just an opportunity that it still means that these uranium stocks are still buys today?
Oh yeah, they're definitely still buys, but it's just a matter of avoiding the wrong ones. I think Kazatomprom probably has had some issues because of all the geopolitical risk, things like that, and it has a lot of weight in some of these. So, but if you look at CCJ, like it's CCJ is doing just fine. So there
exactly.
you go.
So yeah,
That firm's falling off a cliff for maybe decent reasons, but you look at Cameco, who all of a sudden their phone's probably ringing off the hook because people need their uranium and they're at a new high.
Yeah, though, for sure. Like, what a great push up to like $31 on the upside. But certainly, I think uranium is something to keep watching. We can't talk commodities without poking at gold and silver here a little bit. And obviously, there's two schools of opinions on this. There's those that are purely technically looking at this as a very legitimate breakout that has happened over the last month on the upside, that had gold retesting its previous highs from 2020 and a nice bull trend. But then I've heard others that are, with this geopolitical backdrop and all of this stuff, the fact that gold isn't already at 2,500 or more, that it's just evidence that gold is dead. And I don't, I'm more on the bull side of this camp. But like, what's your take on this?
Yeah, I'm incredibly bullish. Like, to me, the fundamentals are great right now. The technicals are great. Like, I don't know what more you would want in a trade than what gold's offering at the moment. The macro backdrop, I think is solid just from the basic. It tends to do well during, right about now during a hiking cycle. Even though I really fade all this, like the whole world just changed because the U.S. canceled out Russia's FX reserves. I think that a lot of the narratives around that are very overblown, but I do think that it will create some incremental gold demand for reserves. And gold's a small enough market to where like that could matter significantly. So I do think, that's not nothing. Like that can create some real demand. So to me, everything is telling me that gold is in a good spot right now. And, the recent sell-off kind of makes sense. It's just a natural smackdown from the old high. Like that's just normal.
Right. How about the other precious metals? I guess you're just basking them all as opportunities all at once. Like what's interesting is platinum has been dogging it a little bit more. Obviously, it tried to break out with a rally. The sell-off's been a little bit deeper. I like to track Stillwater and a couple of these other names. Do you have any opinions on this, or you think just in the bigger picture, these precious metals are all going to have a bullish tilt?
Yeah, it's a little tougher with the more industrial ones. I could see where having a kind of a global growth slowdown could sting, but at the same time, also, if like palladium, if Russian production, is it going to get to market, then it does make sense to keep moving higher. Both platinum and palladium, technically, I think you kind of make the case either way, and you could make a convincing case either way. I do own both. There's an ETF called GLTR. It kind of owns all the metals and all the precious metals, and so I do own that, but I'm much more excited about just gold, honestly.
Right. Do you think silver has the potential to be a better leveraged vehicle on the upside if gold breaks out? Because they tend to have correlation. Do you think you can contain a better percentage return or going to the little cousin?
My guess is the opposite, that it'll be gold, just because I think some of that industrial demand can get stripped off as the globe kind of slows with energy and food and the dollar all kind of being up. Like that global growth kind of slowing down should hurt silver more than tagging along with gold on the sort of monetary side will do, I think. But hey, I could be wrong about that.
Yeah. Another space that's been really hot in the commodity space has obviously been the grains, and even the ag stocks, like looking at charts like Nutrien and Mosaic and others that have just gone like bonkers to the upside.
Mm-hmm.
But obviously, when you step and look at the geopolitical backdrop, like when we almost had a doubling of wheat in a month on the upside, the question is how much has already been baked in the cake? It's now given half of that gain back in a typical kind of retracing move. The question here is wheat in your mind a buy on dip in these conditions?
To me, wheat's too tough. Like it really just comes down to whether it can get out of Russia and in Ukraine, and that's really difficult to get a read on. It's been really volatile. It's really expensive already. Like it's so easy to imagine it going way higher or way lower. And I just don't like trades like that. I mean, obviously if you just put a real tight stop on it, like you could make it work, but to me, it's too hard. So I'm not trading wheat right now.
No, when you look, corn's been in a good trend. It's been actually holding up very, very well along the upside. The beans have been also quietly crawling higher, not making higher highs in the last month, but certainly have been holding up. And then you take a quick peek at rice futures, and it looks like a outright bull flag breakout, isn't it? Like
I think so.
as a pretty classic thing. Like maybe the opportunity is to kind of go to some of those that aren't getting the same attention as wheat.
Yeah, I think so. For me, it's corn and rice, but especially corn, because corn and rice are both very nitrogen fertilizer like hungry. They need a bunch. So I think you'll end up with a lot less corn planting and a lot more bean planting. In fact, it looks like this year will be only the third time in history in the U.S. that we have more beans than corn. Uh, so I think, and even with that, because of the fertilizer crisis, you'll probably have lower yields and less acres. So to me, corn can go much higher from here.
Right, right. Let's touch on lumber. Do you have any calls on this? Like, I mean, first of all, I was shocked at the Eiffel Tower formation that happened in the first place in 2021 on lumber. Like first going up to 1700 and then wiping down to under 500 in a span of like a half a year. Just extraordinary volatility for a commodity, and then it just started ripping to the upside. But it's been so quiet here. Obviously, a part of slowing the economy and taming
Mm-hmm.
inflation is to kind of stall out home building and things like this. Do you think that this is going to be more of a repressed commodity, and that we are now going to see this more grind from here?
Yeah, I think that's very possible. This one's tough for me because, first of all, it's a very much an adult swim market. That is not for kids to play with. That's for sure.
Yeah.
But if you kind of look at through like the backlog for housing in the U.S., it's really at the highest it's ever been. When if you kind of like stack up, permits and everything like that, it all ends up being like, wow, we've never really had this much in the pipeline before. So there's significant demand there. We have a pretty big housing shortage, and for the first time really in a long time, the work is being done to kind of plug it. But yeah, at the same time, it's kind of obvious the Fed's going to tighten until the economy slows down a lot and mortgage yields are going straight up right now. That eventually starts to really matter,
Yeah.
especially if unemployment starts to tick higher. So you can kind of argue it both ways. And because of that, I just don't have any interest in really being involved at the moment. But I
Right.
do own timber. It's just kind of an asset class pretty much at all times, and it's going to largely follow lumber. So I guess I am
Yeah.
kind of long in a roundabout way.
Well, let's use that to just take a second to step over to the home builders. Do you have a call on this? Like the home builders have just been hammered. It's obviously been a favorite space for a lot of our our guests that come on, and even we've heard Kevin take a bull tilt on this. But really, this chart looks pretty damn ugly. I mean, look, the whole stock market bounced and is working its way higher, and we're about to see a fresh new low on these home builders on the downside. Do you have an opinion on this?
Yeah, I mean, to me, like all of their input costs are going higher, and their output cost is going to slow down. So, labor, pretty much every input they have, other than I guess lumber at the moment, has been going through the roof. And I figure, interest rates are going to cap, how much they can make selling homes. So I don't really, I have no interest in being long. That's for sure. If anything, they might be a decent short candidate.
Oh, you think there's room for the downside, right? Like, I mean, if we step and look at this on a weekly chart, first of all, what an extraordinary run they had off that COVID low, right? But I mean, when you look at where they potentially could come back to some supports, I mean, obviously there's these consolidations that have happened here near the 200-week moving average down around 55. Let's just round it for the purposes of keeping it simple. But I mean, that could be a short-term target, but like it's still just one space that just keeps getting hammered here. It'll be really interesting to see, whether or not there's more downside. And you're right, like it's an ugly enough chart. Like when it's below both moving averages, and when the whole market is moving higher, and this can't get any tailwind, just tells you just how much distribution is still coming in the space, right?
Yeah, exactly. And this is one where, technicals and fundamentals kind of line up and to me, like in a really bad way. Whereas, some of this other stuff we've looked at, the technicals and fundamentals are both good. So like gold, both look good to me. When I look at housing, I don't like the fundamentals, the macro, and I don't like the chart.
Yeah. Let's talk some of these softs, and what a breakout in cotton. Cotton has actually had, and I know you love your trend line, so let me just throw this trend line along the bottom. I'll even use my thick marker or crayon here, but you can see here that this has just been a beautiful upwards channel, and that pullback was as classic as they get for a continuation pattern to the upside. You have a call on cotton. You still long this space or bullish?
Yeah, love cotton. Have for no, that's one. It's one I lost on one of the pullbacks at some point and didn't get back in, unfortunately. But yeah, it's been one of my favorite charts for the last couple of years, and it looks like there's a decent chance we have another kind of like dry year in Texas, and that would allow cotton to really get after it.
Yeah, let's touch on just some of all of them here, like sugar. It's been spent about last 3-4 months kind of pulling back, but here got back above its moving averages. Nice little flagging formation rolling up. It feels like it's going to give a shot at those 52-week highs on the continuous chart here. Do you have any opinions on this one?
Yeah, very very bullish sugar. I think all of a sudden we need it to turn it into fuel, like obviously. So it has a new big chunk of demand, and like you say, it's kind of breaking above a giant bull flag. It's kind of perfect setup, really.
And we can't talk softs without touching on coffee. And what's interesting is coffee has been one of the most bullish commodities throughout 2021. Like what a run, a clear double in the commodity over that period. But after prairie dogging its previous attempting to do a little high there, it's been selling. It's been now a couple months of downward selling. Is this a buy on dip? I mean, I know you like to watch all of these previous highs and support lines here. Is this a tactical place in your mind?
So, I mean, the area you drew definitely looks like some like real support, but to me, like so much good happened there. And you had two just horrific crops like in a row, and mostly it's based on weather in Brazil. And so at this point, and coffee has a weird cycle where it kind of think it has like a couple good years and a couple bad years. It's like a normal cycle. So it naturally is probably going to have a good bounce back for the crop itself. And so much good already happened. So it like you can obviously draw a pretty nasty downtrend line. If we break above that, then like yeah, it's pretty interesting, and maybe I'll get long just based on the chart. But just the fundamentals though are kind of tough. It makes me nervous. Yeah, exactly.
Yeah, yeah. Well, you know what? It'll certainly be interesting to see how this all plays out. Was there a commodity I didn't cover that you still want to touch on?
You can go down and look at cattle. I think cattle are pretty interesting, live cattle especially.
Sure. So here we go. So the live cattle charts. It's interesting here that it obviously had that little 1 week kind of throwback in the charts,
Mm-hmm.
and it's been actually working its way right back up. You still bullish here on the live cattle?
I am. I think you could kind of have a new breakout here soon. Obviously, it has like a little bit of like a head and shoulder like looking setup too, so it's a little nerve wracking. But even if you only used say like a daily close beneath that moving average, then that's enough to kind of let you
Well,
have a tight stop, but a lot of upside.
you know what makes me more nervous than a head and shoulders pattern is if everyone learns to eat lentils. Uh,
It's fair.
That's the best way to fight inflation, right? No, anyway, but it's certainly going to be interesting to see whether they can pull a new high. Anyway, let's get to some of the different currencies, and I know one of the things that you've been watching is the Brazilian real. And so let's take a quick peek on this. Now you went to big picture, like you went
Monthly.
you went onto that monthly chart. Let me just throw this here because well, first of all, let's talk this daily chart. That's nuts. Like the currency is just getting hammered. The U.S. dollar is getting hammered versus it on the downside, and what a reversal that has been, right? And we could even talk the Brazilian index because the Brazilian stock market has been just doing so well here. But nonetheless, let's just touch on this monthly chart and just kind of step back and really look at what's going on here. And I know you were focused a lot on the last few years of these different zones right up here, and just highlighting this breakdown is pretty significant, right?
Yeah, absolutely. And kind of broke like an uptrend line and then like a really significant rectangle that you just drew. And um, to me, so I've been long the real all year and long the ETF for most of the year, the equity ETF. I just think I'm writing my monthly piece right now on Brazil, and I just think Brazil is in a really good spot.
Yeah.
All the things that are going up in price, essentially food and well, just pretty much all commodities. They have significant exposure to commodities. They've already done significant monetary tightening, so like they have so much of that that's behind them and not in front of them, the way it is in the U.S. So I think it's something that can kind of keep running. Obviously, it would not be a shock to have a bounce here because it's been so relentless this week, but
Yeah, this is
it's
not
like
the
one of
time to
the
get into the brand new trade, but you need
yeah.
obviously things to pause and settle in so you can reset your risk reward kind of for your entry levels. But it is definitely significant. One of the interesting things is that the markets, like let's just touch on the Brazilian index here for just a moment, just so our listeners can just observe this. But you just has been doing incredibly well since the start of the year. Obviously, there was quite a messy bear market during
Mm-hmm.
2021, which actually arguably has made this entire space that much more attractive because you're starting from a much better base for getting a nice upside payoff. But what's interesting is many of the commodity-driven markets, like look at the Canadian TSX, just broke to a fresh new high. Like the Canadians didn't get the memo that there's a market correction going on around developed markets, and certainly Justin Trudeau is arguably not helping the situation. But here you have the Canadian market just attracting money flow because it's the politically safe supplier of resources to the United
Exactly.
States in global geopolitical uncertainty, right? And so just being long commodity driven economies is so important. Like the Oz, what's interesting is the Australian market hasn't broken out to 52-week highs yet, but it's getting there. Would you have a bullish tilt on the Aussie market as much as the Canadian and Brazilian?
Yeah, absolutely. I mean, they're going to be a big part of filling the hole in a lot of this commodity shortage, especially for Asia, as some of the Asian buyers kind of step away from Russia to try and keep themselves from getting in the sanctions party. So yeah, I think any kind of Western commodity producer is going to have their currency and their equity markets do well.
Yeah, it's but yeah, let's go circle back to talking those currencies. So we just talked about the Brazilian one, but what I found particularly interesting is that typically and often you would see that the U.S. dollar would be trending one way, and a lot of all the cross currencies would tend to all correlate and kind of work in line, and it would be the dollar against the basket, but it's been just one serious muddle this year. The euro's going one way and the Japanese yen's going the other, and the Canadian dollar's grinding sideways, and you've got all sorts of things, and nothing seems to be lining up on that front. I mean, do you have a bigger picture kind of view of what's going on in the currency markets, and is there one that you particularly want to look at here?
Yeah, I mean, yeah, pull up the yen because that one's been significant. And to me, like if you look at like rage is just or yields are just raging higher in the U.S., but yet stocks are actually doing pretty decent in that light. And when I look at the yen, one thing I kind of think is like maybe we are seeing some significant capital outflows, and a lot of it's finding its way into kind of U.S. large caps. That's kind of what yen shows me, and obviously at the same time, if they're going to defend their rate peg, they're gonna have to devalue the yen pretty significantly. So I think it's a chart that makes a lot of sense right now.
Well, it makes a lot of sense, but it's kind of hard. Like after 3 consecutive weeks like this,
Yeah.
putting on 700 pips, it's kind of hard to get into the trade now, right?
Yeah,
Like,
absolutely.
but like when you go and look at the monthly chart and just zoom out, and you look at the yen has been just for
Yeah, man, that's like 7 years or something right there.
7 year sideways consolidation quiet. But like when you look at the window of Abenomics, that 2000 and like in that, or that period, like that
Hmm.
2013 to 2015 window, when this currency trends, it trends.
Exactly.
And we're approaching some pretty critical overhead resistance levels where all these previous highs have occurred right along here. Obviously, the first thing to expect is it's going to bump its head here, right? Like it's going to
Absolutely.
find some resistance along those highs. But it'll be really interesting to see in the coming months whether or not it just consolidates up here and just unwinds that overbought state and just sets up for another full leg higher. Maybe it's not a trade here in March, but maybe by May or June, when we're after we've seen it settle down a little bit, it's going to be a currency to come back and revisit, right?
Yeah, exactly. If it gets down to kind of that 116 area, like that's kind of where I think it's real interesting. And if you're not long yet, is a good place to kind of keep an eye on.
Yeah, maybe you should give Kevin a quick memo because he keeps trying to short the U.S. dollar against the yen, and he's getting pummeled. I don't know
Yeah.
whether he's still in the position,
I would
but
assume no on that last few
yeah,
days. Yeah.
yeah. Anyway, do you have a call on the euro? Like this, it seems like the currency can't get any traction on a follow through rally. It almost looks as bad as the home builders chart. But when you look at this, there's some pretty significant multi-year lows in 2017 and 2020 occurring down in this kind of 104 to, let's call it, 106, 107 window. You think that we visit down into that area here?
Yeah, I think there's a good chance of it, and I think that could end up being a pretty good spot to take a shot at it. But yeah, when I just look at it short term, the daily chart kind of looks like a little bit of a bear flag that could break down, and then if you just think about the lack of resources they have right now, they're going to have to import a lot of oil and gas. Are going to cost them just an absolute fortune. They don't have cheap natural
Yeah.
gas the way the U.S. or Australia does, and stuff like that's going to, I think, make them continue to kind of melt lower, and they're gonna raise rates a lot less than the U.S. I would assume. So it's hard to see a fundamental backdrop for the euro to really make a much of a move higher. They have so much more exposure to Russia as well. Now, obviously, if the Russia thing just ends overnight and everyone can start singing "Kumbaya" again, then the euro would probably have a significant relief rally. But as long as that's not the case, I think we break lower for at least one more low.
Yeah, it seems like the prevailing trends are the path of least resistance, and you don't want to be sticking your neck out and fighting these trends that are established at this stage anyway. Let's talk about the asset that shall not be named. You think that could be a low that's being established here?
Yeah, I think it's possible. And to me, crypto is just a trading sardine, but it's one I love to trade. I think Bitcoin, Ethereum, Solana, they all have all of a sudden pretty decent looking charts. I I don't understand the fundamentals, much less comment on them, but the charts I think look pretty good, and they look like they can have a significant breakout.
There you go. All right. We're almost done, but we got to talk. You talked about, or at least wanted to discuss Secor. Let's.
SMHI.
SMHI. There we go. Thank you. When first of all, you sent me this idea, a couple days ago, and I was like, man, I should have, I should have taken already. Like, what a great day! First of all, congratulations if you're already in this, but obviously, these kind of transportation stocks have had a pretty good move in the last little bit. Now you were looking at this a little bit bigger picture on the
Yeah, if
weekly
you look at
chart.
it, yeah, on that
Yeah,
weekly, it like currently, like today, essentially, it's breaking above a 2 year, but really 2.5 year base, and to
yeah.
me, that's really significant.
And
So,
one of the characteristics that I look at is that it stopped making lower lows
mhm.
over a year ago, right? So like this is an quiet accumulation cycle that's been more or less happening, and this breakout has really set it in motion. But is there a story behind Secor that you like versus a lot of the other shippers that have already been running?
So essentially, so I'm along a few names in the offshore oil space, and you kind of have some high class ones that aren't really hairy, like Valaris and Noble, and then you have the hairy ones that had a lot of debt. Uh, there's a few of those. Transocean. There's Boar. Like there's a few, like they're nasty, but like all of a sudden they're going to go from hemorrhaging money and selling off rigs to being, and a lot of them, their utilization rates have been under 50% for the last few years because no one needed offshore oil. But now all of a sudden
Right.
everyone needs offshore oil. They're going to need those rigs. So like Board is going to go from basically bankrupt last year to having all of their rigs deployed by the end of this year, and day
Wow.
rates are just starting to pop for offshore oil rigs. So I think it's just a space that can dramatically re-rate in the next few months. It's an area like I've put a lot of money to work in, kind of in the first quarter of 2022.
Yeah, this is one of these that, well, yeah, you're not buying at $4 anymore, and it's doubled since the start of the year. But very similar to like the coal plays back in
Exactly.
a year ago. A double is nothing. I mean, these could be $14 or $20 stocks a year from now, right?
Yeah. So
And
when I pitched like BTU on the show, however long ago that was, and it tripled within like 2 months. To me, like this is the same story for especially the more troubled offshore names. Like some of them, they already went through bankruptcy and they kind of cleared their books, and they look a lot healthier.
yeah,
But the ones that
here's a
haven't done
chart
that,
on like Rig, which has just an awful balance sheet, right? And it's
exactly,
got,
that's the
but
kind that can just absolutely rip later this year.
yeah, like what a crazy setup that some of these are definitely having. All right, but okay, do you have a call on actual shippers themselves? Like I was looking at just huge move that's been underway on things like Zim. ZIM obviously recently just paid a dividend,
Hmm.
a sizable dividend, but these stocks have just been running. And recently, one that Cuppy has mentioned on the show in the past, like Sting, Scorpio Tankers, well off of its lows. It just doubled in this year. They've been all ripping to the upside. Do you have a call on these?
Yeah, I mean, I think tankers are in a good spot. They were basically dead money until the invasion, but the invasion means a lot of oil has to go to new places on new routes, and it's going to be stuck on the water a lot longer. So this is all obviously good for that industry. So yeah, I mean, to me, it's bullish for sure. As far as like non-oil shipping stuff, I don't have an opinion and probably wouldn't mess with it. But when it comes to oil tankers themselves, it's not something I like to be long for very long because they're just dangerous and they
Yeah.
find a way to. Same with offshore oil. Like you catch inflection points only because they will find a way to destroy capital. Um, but you can, if when you capture the right part of a cycle, it can make a significant difference to your portfolio. But it
All
can also
right.
make a significant difference if you get it wrong.
Okay, so I'm going to trap you on the last question. What the heck is going on with Tesla?
Oh man, I haven't known what's going on with Tesla since Tesla started trading. I don't think so. I am the
Well,
wrong
listen. Okay,
person
let
on
me
that.
rephrase the question: Is Elon Musk going to be the richest man in the world again in the next little bit?
I don't think so, but to me, like this has like all their input costs are just flying, and again, the economy's going to slow down, and I would assume sales are going to have at least a little bit of a problem at some point. So to me, it doesn't make sense for it to be anywhere near here. But
But didn't Nancy Pelosi just buy some recently? I
oh
think
no,
you're fighting a pretty strong macro force.
yeah, that's I mean that's the Druckenmiller of Congress, so you can't mess with that.
All right. Well, listen, Chase, thanks for pinch hitting and coming and talking some charts with me. And you're always awesome. And we look forward to having you back in the future. But before I let you go, why don't you do a quick little plug for yourself? Where can people follow you? Where can people find you and subscribe to your awesome service?
Yeah, sure. Thanks so much for having me, and get well soon, Kev. We look forward to having you back. You can find me on Twitter at PineConeMacro and on pineconemacro.com. If you want some samples of our research, just hit us up there.
All right. Thanks, Chase. Have a great one, bud.
You too. Take it easy.
Well, thanks for tuning into the Market Huddle. We appreciate you spending the time with us. You can give us a follow at the Market Huddle. And if you could, please rate and review us on iTunes. And listen, you can never have too many friends. Bear market, bull market, we're just happy to have you join us on this crazy ride. Thanks, and we'll see you all next week.